Well, good morning, everyone, and happy Wednesday. Today is Wednesday, the 25th of September. Tomorrow we have GDP. Now, let's start looking at the stock market. This is the 50-day moving average, and you could see we're getting close. This is the overnight session. This is where we closed last night. But as you could see, we're edging towards that 50-day moving average, and what I'm afraid that's going to happen is we're actually going to hit the 200-day and kind of fluctuate between the 50-day and the 200-day, the 50-day and the 200-day for a bit longer, at least till this China-U.S. tariff is resolved. Now, big economic data tomorrow, GDP and jobless claims, and international trade in goods. To add insult to injury in light of this tariff trade war we're seeing. So, I already gave you my prognosis on GDP. The expectations is 2%. Don't expect a big or a lot of volatility or volume today. Usually markets are subdued heading into GDP. GDP is the biggest report of the quarter because GDP tells us the health of the economy. Keep something in mind. 2/3 of GDP is retail sales. So if retail sales are low, it really impacts GDP. So far, retail sales have been reasonable. A little lower than we'd like to see, but they've been reasonable. All right, so here's what you need to look at in light of the trading action, in light of the S&P 500 being near the 50-day moving average. This is the put-to-call ratio. Usually, it's fairly random. The only times we want to look at it is when the market gets above 115 or below, say, 85, 80. Right now, it's right at 115. If it goes a little bit higher, it's going to tell us that the market, that bears are getting very panicky. Usually, when bears get very panicky, the put-to-call ratio reverses and the market comes up. But we're not there yet, and based on the fact that we've been going to about 125, 130 the last month or so on the put-to-call, there's a good chance we'll go to about 125 or 130 before we reverse. What does that mean? That means the market has more downside or more sideways trading action. It means we're not ready for a bounce just yet. Again, expect slow trading action going into tomorrow. We have GDP. Keep your eye tomorrow on the long bond. This is the long bond. Notice it's been going higher while the S&P has been going lower. Usually that's what happens. If GDP is on the weaker end tomorrow, we're going to see bonds rally. If GDP is on the stronger end of the spectrum, that means the economy is really strong. That means there's less chance of Fed lowering rates. If there's a less chance of Fed lowering rates, there's less chance of TLT moving higher. Again, TLT is a 30-year long bond. It tracks the long bond, the 30-year futures contract. You don't have to trade the 30-year futures contract. You could trade the TLT. This is a great defensive asset and an asset you should really consider putting some portion of your portfolio in, especially prior to major news releases like GDP. Again, S&P 500, let's just quickly look back here. This is the futures contract, so it's already representing what we're seeing this morning before the open. We're down one. We closed right here at this bar yesterday, and unless there's something happens that's totally unforeseeable, I'm expecting the S&P to hit the 50-day line and more sideways to trading action next few days. Talk to you guys soon. Take care.